Hi, Luke Fannin here from the business faculty in AIT. We're looking at auditor's opinion. It's the audit report and the auditor's opinion that's given in that, and when that opinion is modified, when there is some problem, some material or some pervasive problem with the financial statements, the auditor's opinion will be modified. And there are three types of modification: qualified, adverse, or disclaimer. And you have to know those, how they look in terms of, in our opinion, or what that means, how to write it, and how to get to that point. We've already looked at unmodified opinion. So when the financial statements have no material problems or no material errors, the auditor issues an unmodified audit opinion. An example of that is here, where in our opinion the financial statements give a true and fair view. That's unmodified. However, modified is where there is a material and pervasive issue, and then the auditor's opinion is changed, and they can't just say it gives a true and fair view. They have to add on and either qualify the statement or else issue a different type of opinion. This comes up in past questions in terms of, you normally get some scenarios. Like here are 3 scenarios. I'm not going to go read them now. We might look at them again in a few minutes. But you get up to 5 scenarios, I'd say, in a 20-mark question. And then you're asked to evaluate the implications for the audit report. And that can be asked in a number of different ways. So normally it comes up quite a lot, this question, in exams. Discuss and justify the type of audit opinion you intend to issue for each of the 4. State clearly any assumptions. Same type question. Here, in respect of the 3 situations outlined above, discuss whether the report should be modified or not. And so you have to then come to a conclusion on that. It could also ask you in terms of going concern. So describe the impact on the audit report if the issue remains unresolved. And we'll just look at another one here. Outline appropriate changes to financial statements, which you may have to discuss anyway in all of these if there's an error, and modifications to the audit report. So that's generally how they're asked. This bit, further actions, is slightly different, and we'll look at that again. So just to get back, they're the modifications, and keep them in mind. When looking at a question, you need to go through this process, and you'll have to document this in your answer, and we'll do that for some past questions. So firstly, establish if there is an error, which means the auditor knows there's a mistake that has been made in the financial statements. So the mistake will be something where the company has accounted for something incorrectly that is not in line with accounting standards, or else they've disclosed something incorrectly. So it can be an error in the income statement, an error in so if we look down here, any of these, an error in the income statement, balance sheet, notes or disclosures as they're sometimes known, or 4, 5, 6 these either. But really we look mostly in questions at the income statement, balance sheet, and the notes or disclosures. Establish if the issue is immaterial, material, or pervasive. So any immaterial issues are those that are not going to affect the judgment of users of the accounts, of a reasonable user, reasonably informed user. So anything immaterial means the auditor can issue unmodified audit report, which once again was Glanbia. So perhaps in the Glanbia financial statements here, there may have been some immaterial errors that were not corrected. Probably not, I'd say they're all corrected, but there could have been immaterial errors, and if there were, the auditor is still able to give unmodified or there were maybe some immaterial limitations of scope as well, and the immaterial do not result in modified opinion. The auditor can issue unmodified, saying the financial statements give a true and fair view. However, where they're material or pervasive, then that affects the audit opinion. And how that affects the audit opinion we'll see here if we just go down. So I said there are two types of qualified opinions, and then adverse and disclaimer. So we'll look in a bit of detail what's material, what's pervasive, but material is an important issue. Pervasive is a very important issue, if you want to term it like that, a bigger issue. So a non-corrected error in the financial statements. For a material issue, what you're saying is the financial statements are true and fair. You can rely on them except for this part here. So what you say, the financial statements are true and fair except for the error in X. And the auditor will explain what the error is and how it impacted on the profit. An adverse opinion is where the error in the accounts is so big that it renders the accounts misleading, that as a whole users shouldn't rely on them to make decisions. So the adverse opinion is where the auditor says the financial statements are not true and fair. So it can be difficult to get examples, particularly in published or public limited companies accounts, of adverse and qualified opinions, because the directors will get asked by the auditors to correct any mistakes, or to, there shouldn't be any limitations of scope. So it's difficult to find examples of these type of modifications. But I found this on the independent.ie back in 2013, and the K Club is the golf club in Ireland, and the auditors, it says here, issue warning over failure to write down assets. So really what they should have said is the K Club auditors issue an adverse audit report, but people wouldn't understand what that means. And what happened is the failure of the K Club to write down the value of its assets led KPMG to issue an adverse audit report. So the auditors believed that there was an error in the accounts, and the error was pervasive. So this section here, the failure to write down the assets materially overstate the carrying value of the group's fixed assets, understate its loss, and overstate retained earning. And the amounts are up here. And the auditors said published information, comparable properties indicates very significant reductions. So therefore, in view of the failure to provide for the impairment, KPMG, in their opinion, said the financial statements do not give a true and fair view. So that's an example of an adverse audit report. And I'll give the K Club the chance to reply here. The current market conditions are not relevant. So that was their belief. But really, in terms of financial accounts, they should have written down the value of the assets. So the accounts were seriously misleading. So the auditors issued. So the adverse opinion is there. And that was an example of one there by KPMG in the audit of the K Club. A limitation of scope is where, for some reason, the auditor is unable to obtain sufficient evidence about a matter. Therefore, there may be errors. We call them possible errors in the accounts. And so a qualified opinion is used where there's a material matter. So an important matter, a matter greater than 5% of the profit before tax, usually is the gauge we use, the criteria. And down here, it's the same thing. You're saying the financial statements are true and fair, except for this area about which we're unable to gain information. So financial statements are true and fair, except for possible errors. And it's important to say possible errors, about which we're unable to obtain sufficient appropriate evidence. So for both types of qualified opinion, the auditor is saying, yes, you can rely on most of the accounts, except for these certain areas. So the financial statements are broadly true and fair, except for specific areas. And so they're pointing them out to the users. When there are pervasive matters affecting the financial statements, then where the auditor knows there's an uncorrected error, then it's an adverse opinion where they say the financial statements are not true and fair, so they're not at all reliable, don't rely on them. Or where it's a limitation of scope, the auditors give a disclaimer of opinion. On A, where they say they're unable to give an opinion on the financial statements. So we look at material pervasive, and we look at the different examples of that, and then applying to exam question. So we might do that in the next screencast. So thanks for watching that, and the next screencast we'll kind of dive into what's examples of uncorrected errors, limitations of scope, and then how to determine materiality, and then applying this. So thanks for watching.